Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, February the 19th, 2026. Okay, the main thing I want to look at just quickly to start off with is just the oil price here. Obviously, this sort of the tensions around sort of the US and Iran seem to be sort of increasing somewhat. There was a second aircraft carrier, the Gerald Ford, which was dispatched a couple of days ago from sort of the Western Hemisphere. That was actually involved in Venezuela. That was dispatched over towards the Gulf state and apparently will be there in the next few days. So the point is that the US have a significant fleet. They have two aircraft carriers. They've moved in a lot of sort of soldiers, air defense systems. Basically, there's been a very significant buildup of equipment and materiel and troops, and not to mention the sort of the naval forces and the aircraft there. So the point is that from what I'm reading, doing quite a lot of research on it, that the US is now in a position to not only sustainably or attack in a sustained manner Iran, so not just one sort of attack, but maybe a multi-day or even multi-week kind of sort of war. But also they've put in sort of defense mechanisms for their own bases and for Israel and whatnot. So the point is that the situation is now quite different from, let's say, a week or two ago, where the US, realistically didn't actually have enough forces in that area. But now they do seem to have enough forces in the area, and especially in another week or two, they will be at a very sort of significant capacity. So the point I'm trying to make is that I do believe that there is a chance for a significant sort of event, and basically that's what the market is thinking as well. Now, is it going to happen? Possibly not. The Trump administration seems to be wanting to do a deal. And secondly, and maybe even more importantly, from a domestic political sort of situation, any kind of significant attack on Iran and counterattack by Iran, and obviously sort of closing the Strait of Hormuz would have political repercussions back at home with the increased oil prices. And going into the midterm elections, Trump is very focused on the question of affordability, and prices of gasoline at the pump is a big problem for American consumers. So we have to assume that from a political point of view, Trump absolutely doesn't want an escalation if it were to cause a spike in prices. Now, is the political calculus going to be, hey, here we are on February the 19th, we can maybe deal, quote unquote, deal with the Iran situation in a week or two or three or four, and even if that causes a short-term spike in oil, that will have dissipated in another few months. And it's better to kind of get this problem out of the way rather than sooner rather than later. I don't know. But what I do know is that the oil price is definitely sort of picking up on all of these tremors. And we can see that oil the last couple of days and even overnight has had a pretty significant move upwards from about $62 up over 66. As you can see, we're getting up to recent highs here at about 66.37 on the front contract. So the point is, if there's any more aggressive rhetoric coming out of the White House and Iran, both of them being quite sort of aggressive in a certain sense. If there's anything which is specifically pointing to a genuine breakdown in negotiations and talks, you've got to think that oil here can break this recent high of 66.50. And essentially, at least go up to maybe this recent high here at 68 or even further. Now, of course, this is WTI. So you see, even on Brent oil, it's even a little bit more. And we can see this if we look at the time spreads. Look at a few time spreads here. So here's sort of April to June. We're not seeing a huge sort of spike up in that one, but where we are seeing that is if you look a bit further out. So you see here, this is the CL1 to the December 26 contract. You can see the time spreads are pushing up. And if you look at something like Z26, Z27, so December 26, December 27, you can see that that's pushed up quite a lot. So the point is that the time spreads are signaling some sort of stress as well as the outright prices. So that's an interesting thing to keep an eye out for. So just going back to the main charts here. But what is interesting is that if we look at something like gold, just on the futures here, that's not really spiking too much higher. I mean, it's gone up a little bit yesterday. And of course, any outbreak would probably lead to a massive spike higher. But gold at this point, not really sort of signaling that. It's just sort of in the sideways consolidation. If we look at silver on the futures, also in a sideways consolidation. But again, as I say, any outbreak of real hostilities, they will probably spike higher, especially gold. We can see that copper is in a sort of a, just a sideways consolidation here, fairly sort of subdued price action. And I just wonder whether this is the lack of the Chinese participants. We know that for Chinese New Year, those markets are closed for the week, for the Golden Week. So possibly that's signaling that. But I'm a little surprised to see that gold hasn't picked up too much of a safe haven bid. Just while we're here, we also have BTC continuing to show very distributive and flat price action. But where the oil price is being felt a little bit is in the bonds. So if we look here at I just want to look at some of the yields here. So let's just look at, let's say, the 10-year yield. You can see here that the 10-year yield is pushing higher. And that's a combination of factors, one of which, of course, is a fear of energy-driven inflation. So obviously, if oil prices were to spike, and some people are saying that closing the Strait of Hormuz and a significant reduction in Iranian oil and the flows. Keep in mind that the Strait of Hormuz there is about, I think it's about 16 million barrels a day. So we're talking anything from about 15 to 20% of global oil does flow there, sort of on water at any given moment. So that would be a massive disruption to global or oil supplies. And some commentators have said that that they're expecting it could, oil could spike to $120, $150 a barrel, especially Brent, if that were to escalate that situation there. Anyway, so the point is that on these fears and the reality of higher oil prices, normally there's a relatively strong correlation between oil prices and bond yields, because obviously there's inflationary pressures, which is not great for bond yields. So we're seeing here the bond yields, let's see the 10 years sort of pushing up. We also see the 30-year bond yields are pushing up. So that's not great. The other thing as well, so what I'm trying to say here is that we're not really getting a safe haven flow into gold or silver, and in the bonds we're not getting that either. In fact, we're getting the opposite. We're seeing bonds selling off and the yields going up. So at this point, the market is still sort of keeping an eye, and most of the focus is on the energy markets, on the oil market. The other issue here about the bond yields is that we had a very poor 20-year auction yesterday. And now the 20-year auction, the 20-year duration is not loved by the market. The market much prefers 10-year and the 30-year and other durations. So historically, the 20-year is a poor performer, but it was a pretty poor performance yesterday at the 1 p.m. auction. There was a 2 basis point tail. And that could have contributed just sort of the negative sentiment around the bond yields. Secondly, yesterday we had the FOMC minutes. Now that was from the last meeting where they essentially held, and the market. I mean, you could argue that was slightly more hawkish than expected. I mean, some of the sort of the main headlines coming out was that the risks to the labor market to the downside, so a weakening labor market, according to FOMC members, that has attenuated somewhat. It's kind of sort of softened. So essentially, they don't seem as concerned by the labor market, and then they do seem a little bit more concerned about inflation. So I would say that going forward, the employment numbers, we had pretty good non-farm payrolls, you remember, sort of last Wednesday. And going forward, it seems to me that maybe the bond market is going to be a little more focused on putting the focus back onto inflation readings rather than the labor market, because the FOMC does seem to be less concerned about the labor market and more concerned about the potential for inflation going up. Now, in terms of inflation, there were some concerns expressed by members about inflation, and they don't seem to be the base case still seems to be that inflation will gradually dissipate and sort of go down by the end of 2026. But there are still some concerns, and they were kind of flagging two-way concerns, saying, well, in theory, it looks as though it's going to soften, over the next 6 or 12 months, but we are concerned that it's still sticky and not, sort of actively going down more. And therefore, some members apparently wanted the statement to be a little bit more equivocal, and essentially the last statement from the FOMC, and essentially sort of stating that there were two-sided risks, and that there was even maybe a possibility, if inflation weren't to behave itself, of hikes. So potential for rate hikes. Now that is still probably a minority view, but the point is here is that the FOMC minutes did definitely show a picture of an FOMC, which is, I would say, maybe not hawkish, but definitely more neutral than has maybe the market is thinking. And keep in mind that the market's still pricing in over 2 cuts, about 2.5 cuts for 2026. And just yesterday, we did get a bit of a repricing of that. And you can see here, that's why the yields are going up. Also, if we look at, let's say, the 2-year yield, you can see that also has gone up over the last 2 or 3 days as well. And also you can see the 5-year. Now, that was also because the data yesterday. We had relatively good data for the durable goods, for I think it was industrial production and whatnot. So overall, we can't really take any these sort of one-off sort of data points and say, oh, look, the US economy is doing great. But if you actually start to look at the cumulative effect of, relatively strong sort of employment situation, industrial production, durable goods, it was less bad than feared. It does look as though the US economy is, relatively solid. Let's put it that way. We're certainly very, very far away from some kind of recessionary risks. Now, we're going to have more data this morning. We're going to have the initial jobless claims and continuing claims and a couple of other things. So let's keep an eye on the initial jobless claims and continuing claims in terms of the labor market, the employment market this morning. That, is the consensus is that for that to remain strong. So overall, there is this consensus building that, the US economy is doing okay. And therefore, the concerns are like, well, really, does the Fed really need to be cutting more than twice this year, 2 or 3 times? And of course, we have the whole politics of Kevin Walsh coming in and everything. So kind of an interesting little sort of tug of war going back and forth there. So that's just that there. So let's keep an eye on the energy markets, where, for example, we did get a little bit of I don't know if it's a safe haven. It's interesting to look at something like the Swiss franc here. And I'm going to put that with the euro. So look at the look at euro Swiss franc here. Very, very weak is the euro here against the Swiss franc. Now, is that just concerns about the European economy? The Swiss economy is doing well, low inflation, possibly. But the point is here, this is sort of one-way traffic at this point, and it's also going to be interesting to see when and if the Swiss National Bank may feel like sort of intervening, because in general terms the Swiss franc has been very strong recently. They have low inflation, but the problem is that their interest rate is at zero, and they really do not. The voice to the fact that they actually are not particularly enamored by the idea of going negative again. And at the moment, just FYI kind of thing, there's about 12 basis points of cuts priced in by the end of 2026. So essentially another half cut. And that would take it negative if they were to cut again. So it's just going to be interesting if we do get more of a flare up between the US and Iran and some kind of hot war. I mean, euro Swiss franc looks as though it's trading very, very heavy here. Could that go down? And also could just in general, the pricing for a cut of minus 25 basis points, could that sort of come into being for the Swiss National Bank? Because at a certain point, if the euro becomes too strong, maybe they want to cut, not even so much for inflation sort of concerns, but really just to kind of weaken the currency, which obviously is very bad for tourism, but especially for exporters to have this Swiss franc, which is so strong. So let's keep an eye on the Swiss franc and the data this morning as well, just right at. Okay, in terms of other things, just want to look at the equities here. Let's just have a look at the equities. What I would say is that just have a quick look here at the VIX. The VIX went down yesterday, so volatility fell overall, and we're now but we're still over 20. So I'm trying to say that we're not in these sort of happy days, the dog days of last summer, or even at around Christmas and the end of last year, when we were trading with a 14 or 15 handle. Basically, the market does seem to have ratcheted up into another zone, sort of the 18, 19, 20 handle. And even though volatility, the VIX went down yesterday, you can see that overall, it's not at its lowest level. So the point is there is still quite a lot of choppiness, still some fragility in the market. And just talking about oil again, if you look at oil vol here, OVX, you can see that has actually spiked up again. That's sort of relatively, sort of logical considering what's happening over in the Gulf and also with oil prices. But just to say that bit of contribution to overall volatility is in oil. If we look at gold, that is, up a little bit. You see silver is still pretty flat. So volatility is starting to move up a little bit in some of the other markets. If we look at bond volatility, that came down yesterday. So that's sort of calm. But just to say that volatility is not completely sort of absent at this point. Now, looking at the equities, again, fairly weak price action. We had pretty much a round turn yesterday. And I just want to show you guys something as well. Interesting, just getting back to that 20-year bond auction, which was at 1 p.m. And the results actually came out about at 1 or 2 p.m. Just notice here, sorry, this is this morning, where this is the 3-minute chart here. Just want to show you just also where the bonds started, the equity started selling off yesterday. Now, is this coincidence? I don't think so, because as we saw the bonds, the long-term bonds sell off, you see here at just after 1 p.m. here, about 1:02, you can see the equities had a bit of a dump. Then of course they ripped into the close. But basically, just keep an eye on some of these auctions. Bond yields going up significantly is not a great thing for the equity market, especially the longer duration equities. You can see here the Nasdaq here are selling off just after that bond auction. Now, was it at recent highs? Yes, it was. Now we can see overnight here. I think let's just come back here on the 3 minute chart again. In the European session about 3:30, you can see here that the more equity weakness here. And if we go over to the ES on the 3 minute chart, same thing. So the point here is that going back to the daily chart, you can see here that on the ES futures, pretty weak price action. We're starting to see the 20-day cross over the 50-day. We're starting to see that rallies are being rejected. And just interesting from a technical perspective here, just going to zoom in a little bit or zoom out. If we start looking at some fib reversals here, or just look at a reversal, you can see that even from this most recent impulse down here, that basically failed at the 61.8 fib retracement here, more or less. And so this is a weak price action. And I always like to look at price action because we have all kinds of narratives, but the reality is that the market is trading heavy in the equities. Similar kind of situation in the Nasdaq. I've talked about this for the last few days. Just the rotation. I think, a lot of people have been talking about that. You also see the Russell here outperforming, still doing relatively well. So let's just look quickly at some of these subcomponents. You can see the equal weight actually does remain relatively strong compared to everything else. Let's look at the Mag 7s, which had a bit of a bounce from the 200-day moving average, but still, it's been weak for essentially last few months. It hasn't made a new high for about 4 months. Again, if we're looking at semiconductors, trading well, but starting to show I would say a little bit of tiredness, let's just call it that way, whereas the software is very, very weak. So nothing's really changed. We're still getting this sort of relative performance, relative hierarchy. And I just want to get back to this Mag 7s because it is kind of interesting, this sort of, some of the concerns here. I mean, if we look here, just want to look at a few different charts and a few things and just make a sort of a general point here. Actually, I just had the crude spreads. You see the crude spreads are going up. So I just dug out something yesterday, just in terms of these sort of narratives which we've got at the moment, because all of these narratives here, these are the 8 narratives which are really dominating markets. So maybe just take a second to pause and look at these and just think if you disagree with any of these, could it be a case of doing some kind of sort of counter trade or contrarian trade? Now, I'm not saying I disagree with any of these, but the point is that a lot of these trades have come a long way. So we look at number one, US dollar lower. Why is that? Policy uncertainty, foreign selling of US assets, global diversification, de-dollarization. Okay. There is some reason for that, but also, for example, we had the tick data of sort of a foreign buying of assets yesterday, and foreigners are still buying plenty of US stocks. Was there some selling of US treasuries? Yes, but overall, the treasury market is still pretty strong. Although we did have the weak 20-year auction yesterday. So the point is that is that maybe getting a little tired? This whole US dollar should be low. We're seeing US dollar strength. EM stocks and currencies higher in diversification, carry trades and value hunting. Okay, but the EM markets also have gone up a lot in the last 6 months. So is that getting a little bit tired? Metals higher on shortages due to AI capex, solar usage in solar panels and whatnot. Sure, but we know that the metals have had a bit of a breather. The JGBs, the Japanese bonds, they've bottomed as Takaichi policies are known and uncertainty is gone. So life insurance policies, insurers has come back to the market. So that whole sort of concerned about the Japanese fiscal situation, is that overblown? Time to get out of that trade. Crypto is dead because there's no narrative and retail isn't coming back. That's the consensus at the moment about crypto. But is it time to start looking at some of these crypto markets, even BTC, for longer term? Software as a service is dead because Claude, Anthropic, AI is going to rule the world. Is that oversold? We saw IGVs at lows. Capital expenditure is no longer rewarded because it stems buybacks and ends free capital flow, which is a capex-like utopia for megatech. So I'm going to have a look at that one. And also there's a generational shortage of sort of memory chips, and prices will continue to go to the moon. And the consensus is, oh, you have to own the hardware, the picks and shovels. So the point is, I'm not saying I disagree with any of this, but I just think it's interesting to step back and look at these sort of consensus narratives and individually, look at sort of different sectors, because there's a lot of sectors are very overbought or very oversold. You look at something like the Kospi, it's just ripping higher. You look at, for example, the software IGV is at all-time lows. So at a certain point, we also see the Mag 7 as being beaten down. And just talking about that, I just want to end just having a quick look here. I don't want to go on for too long, but this whole thing of this incredible fear about capital expenditure, and is it justified? And let's just have a look at a couple of charts. Because if you look at the free cash flow, this has been one of the stories, basically saying, oh, all of the free cash flow of these Mag 7 companies, it's all being destroyed. Now, is that true? Yes, it is true to a sense. So if you look at here, Oracle, Meta, Google, Amazon, Microsoft, you can see here the free cash flow. Now that's been an absolute monster for them for many, many, many years. But as we can see in the Q4 2025, is this going down? Yes, it is. We can see that that's a fact that they have less free cash flow. But the reality is that there's still very, very strong companies still making a huge amount of income, of profit, and that a lot of their sort of capital expenditure is being funded sort of internally out of their cash. Now, there is more borrowing, so for sure there is some borrowing going on. But the point I'm trying to make is that, is free cash flow amongst the hyperscalers declining? Yes, it is. Is this a terminal problem? Is this, such a massive problem? You could argue, yes, because no one likes to see free cash flow going down. But on the other hand, you could say that, these are very successful companies who, at a necessary moment, are, in a healthy way, expending on capital expenditure. Okay, what about in terms of, oops, hold on, where are we here? So if you look here at the capital expenditure, is it ramping up? Absolutely. We see here again, Microsoft, Meta, Alphabet, and Amazon. So we can see that the capital expenditure is ramping up. So this is sort of the bear case. You go, look, capital expenditure is out of control. The free cash flow is going down. Look how horrible this is. But then we have to say, but what we really need to do as well, though, is to say, well, okay, is this justified? Is there actually going to be bigger markets for all of these kind of things? We know that for sure that the CPU is being sort of sort of converted into, or shifting over more to GPU sort of sort of gaming units, and there is a kind of a structural change there. And so the point is here, if you look here at the world semiconductor trade statistics, that's where these numbers come from, and Deloitte, the company, you can see here some of the predictions. So the point is here is that this is the revenue slopes, which is optimistic, this sort of purple one ripping higher, and even sort of in a moderate scenario for the future estimates over the next 3, 4, 5 years for basically sort of semiconductor revenues. So the point is that if you look at this kind of chart, you say, well, hey, there is a massive market for this stuff, for chips, for semiconductors and stuff, and also capacity constraints are occurring. If you actually look at, there was some commentary by Microsoft. They were saying that about 40% of the sort of cloud services, they have to give it over to OpenAI. They basically don't have the capacity. Their capacity is constrained. And we also had a commentary from Amazon essentially saying that their cloud business has a huge backlog, and they're basically turning away customers every single day. So the point is that you've got companies like Amazon and Microsoft spending a huge amount of money, but the reality is the demand is there, and also their own internal capacity, especially for cloud computing and compute in general, is constrained. The demand is there, is what they're saying. They need more capacity. And is that going to cost some money over the next 2, 3, 4, 5 years? Yes, but they're convinced that medium term that is a sensible business decision. And if they don't build out their capacity and build up their capacity, they will fall behind. So all I'm trying to say is that let's keep an eye on some of these sort of narratives, and some of these overextensions and some of maybe the Mag 7 company. And well, and I do think that there are potentially some sort of opportunities. And obviously everyone's saying that every sort of software company is going to go to zero, and the Mag 7 is going to go to zero because they're spending too much. But I do believe that now's maybe the moment to start looking at some of these narratives and start sort of looking maybe around for some opportunities at some point. So keep in mind, feel free to do a screenshot if you're in the mood of some of these narratives here. And maybe it's going to be some interesting sort of opportunities there, basically. So okay, guys, so I'm going to leave it there for today because I've spoken too long. So let's keep an eye on the data at 8:30 for the initial jobless claims. Obviously, any headlines over for oil and Iran, and again, some of these things like the crypto getting to lows on the BTC, we're getting the Mag 7s getting to lows, even some of the individual names in the hyperscalers getting to attractive levels. I think that's going to be an interesting one to look at. Also, I want to keep an eye on the long-term bond yields, especially the 10 and the 30, and just see how that's interacting with the oil price to see if that's a concern. And just generally for the indices for the equities, I'll be keeping an eye on the price action, which has remained fairly weak. Also, we have Walmart this morning, if I'm not mistaken. That may already have come out. Sorry, I don't have the numbers for that. 7 o'clock as I'm speaking here. But yeah, we have Walmart. So that's going to be an interesting one just in terms of their commentary about the state of the US consumer. Personally, I'll also be looking at sort of equipment, infrastructure and equipment for John Deere. And I think Wayfair, that's a cute one. The sort of the mass furniture retailer, just also in combination with Walmart for their commentary about the US consumer. Okay, guys, I'll leave it there. Have a great trading day, and I'll be back tomorrow with the macro snapshot from the macro shop. Thanks very much. Have a great day.